Larry Shover, Chief Investment Officer at SFG Alternatives, joins us live in Chicago. Larry, great to have you with us as always. Now, we're watching these shrinking US inventories at a time when OPEC and its allies are cutting that production. So you have supplies declining, a healthy global economy. All the pieces seem to be in place right now. We really have, you'd have to say, a lot of supportive elements at the market that perhaps didn't exist before.
Yeah, I'm against consensus right now. I mean, I do admit that oil's rallied a little bit further than I thought it would, but I think it's making a lot of assumptions. And if you look at the forward curve, I am definitely beneath consensus. I mean, we have to make this a lot of big assumptions that the compliance for OPEC and non-OPEC alike will remain in place. We have to also assume that the 1.8 million barrels a day of demand growth that we saw in the second half of 2017 will continue into 2018. We have to also assume that, the economy itself will continue to grow at the pace that it's growing. So I tend to take the opposite approach. I think $10 lower by the end of the year. I think $48 to $52 a barrel, probably for Brent, and a little bit lower than that, obviously, for WTI.
And does that also come down to what's happening with the US dollar? Because we know that, it has been under some pressure, but largely starting to make a comeback once again. And we know the strength of the US dollar does tend to put some downward pressure on a lot of those key commodities, the likes of gold, which we're seeing in the session today, oil as well. I mean, do you have to take into account the moves that you're expecting with the greenback?
Well, with the greenback, it tends to always overshoot one way and the other way. And right now, I think it deserves to continue to waffle. It has started off out of 2018 on a strong note, but I do think with the lack of inflation, the policy divergence, the growth prospects in the Eurozone compared to the US, interest rate differentials, what have you, I just don't see the greenback rallying by the end of 2018. Quite the opposite. I continue to think the US dollar will go lower.
What about your view on the iron ore price? Because we're always interested in, of course, in what's happening with iron ore. And we mentioned in the story leading up to you that it's reached a bull market last month, but there are signs now that there is excess supply perhaps in the market with, record exports coming out of Port Hedland here in Western Australia. Are you a bear with respect to the iron ore price? Do you think we will expect to see some further weakness from here?
Well, my Western Australian friends tend to be very bearish on the price. All the analysts I know in Australia tend to be very bearish. I'm taking the opposite approach, not because I think that's a good thing to do. This consensus isn't always wrong. But in this case, I do believe that China is going to continue to grow and be a net user of commodities, not the same pace as they were in 2017. But my thinking is that even if they plateau at a very high level, which they are right now, it doesn't have the same impact on iron ore that most people are suggesting is down 10, down 20, down 30% price. I just don't see that happening. I think it's going to be in a very narrow yet volatile trading range, at least the first half of this year.
All right, Larry, let's move on from commodities and talk more broadly about the market. Fresh record highs once again that we are seeing for all three of those indices today. Your view on the market, we've been talking about the fact that there just doesn't seem to be any bad news around at the moment. Investors are so confident in the momentum behind this rally. Do you think it continues, or do you think there are risks at play here and perhaps we're heading in for a correction?
Well, I think eventually we'll have a correction. I don't know when that will be. And I think one of the catalysts have to change. I mean, something with either wage inflation, inflation in general, just the opposite of my conviction with China, that China really does slow down and doesn't become the demand-oriented country for commodities. Central banks, integral part. But right now, I think the markets are just relative. People think valuations are high, and I believe they're high as well. But it's relative to credit, relative to government bonds. Equities are still priced very well on a relative basis. That said, I continue to be very picky. I am neutral in the U.S. I've been neutral in the U.S. for a year now. Overweight in the Eurozone, especially in financials, and that follows in China and Japan as well.
We're, of course, heading into fourth quarter earnings, which are about to kick off. We have a lot of the major banks due out at the end of this week, Larry. We're all looking at, what the companies will be forecasting in the year ahead, and in particular, wanting to hear what tax reform will mean for a lot of these companies. What is your expectation as we do head into the start of earnings season?
You know, I think it's going to surprise us. I think it's going to be a very messy earnings season. And you're right, the banks start off on Friday. I think the write-offs combined with the fact of earnings per share growth, it's going to be a real mishmash between sectors. And I think it's going to pay to be a stock picker finally, just from this earnings season. But I don't think it's going to be as straightforward as it's been in the past. And I also believe that the hurdle rate's a little higher than it was at least last quarter. So it's going to be solid, but it's going to have some definite rough spots with write-offs and forward earnings guidance.
Larry, you point out your various overweights and underweights with respect to, global equity markets. What about if you were a stock picker, though? What sectors would you be eyeing out or zoning in on with particular respect to sectors or individual companies that you might be interested in?
Yeah, so for me, it's financials number one by far, followed by energy-related companies, just because the valuations are so cheap relative to the market, followed by industrials. I think just with with central banks rolling back, I think we're going to start seeing fiscal easing, where governments are going to start doing a lot more infrastructure projects that get this economy moving, and I think industrials be a good place to be.
All right, look, Larry Shover, we'll leave it there. Appreciate you joining us as always. Thank you, and we'll look forward to talking to you again next week.